We are going to discuss a couple of concepts which is involving with the risk and return and how the premium is decided, and after that how the cost of capital is estimated. And all the information that we are going to share now is going to be useful in understanding what should be the discounting rate that you are going to use for the projects that you have for your evaluation. So far we have seen NPV, IRR, other evaluation discounting rates, present values based on a certain factor that we have used as an interest rate or as a discounting rate, right? But in real life, every project has a different risk and hence different required rate of return. So what we want to understand is what should be the required rate of return, minimum required rate of return, which should be used for our project evaluations. So we understand the concept of risk and returns first, and then we will look at the more details of the cost of capital. Consider that there are many investors, right? But let's say you have invested in these categories of stocks, maybe S&P 500, small stocks, world portfolio, the entire world, corporate bonds, or only a treasury bills. Where would you think that will be the highest return that you would get? The highest returns that you are getting is, this is the chart, the returns have been shown since 1925. So you will see the red line, which is the highest line, it's the small stocks. So means if you have invested in the small stocks, $100 in 1925, your investment would have been $3.5 million as of today, right? If you invested in the S&P 500, your investment is only 487,000. If it's world portfolio, then it's 188,000. Corporate bonds are giving 23,000. Treasury bills are giving only $2,000, and the CPI is giving 1,322. Means CPI means the inflation, right? Inflation was in the world is around 1%. Certain investment categories are giving huge returns. Certain investment categories are giving a very small return. So if you put money in the government bond, you are barely making inflation, right? Because the money is not that much of difference, 1,300 or 2,000. So it's not a lot, right? The government is not giving you too much investment. Second one is higher corporate bonds, and then the highest, and then the higher, and then the higher. So why do you think they are so different? What is the reason? Apart from the performance, yes, the risk in each of the stocks. So the treasury bills are the safest investments. They have no risk of default. So hence they are giving also the lowest return. Corporate bonds are slightly riskier, but they still have a collateral. You will not lose your money, though they have a slightly higher return. Then you come with the world stock. The world stock is giving you another good return because it's a combination of some good performing companies and some bad performing companies, right? But overall, if let's say one company wins, another company lose, total is offset. So that's why it's just only a minimum rate of return, because it's not that much of super high risk unless everything is going down or everything is going up. So it's a slightly higher return. Then you have S&P 500, which is slightly higher than the world index, because these 500 companies are not entire world, right? There are certain other companies which are excluded from S&P 500, but S&P 500 is made up of various industries and various companies of different sizes, so that the risk is minimum. But since the risk is minimum, the returns are also minimum. Then the highest ones are the small stocks. So they are the quite high in risk, because they carry a lot of risk of performance, risk of liquidity, risk of market, risk of industry. There are many risks. So that's why their return on investment is also very high. But another thing to look at this chart is also the fact that the up and down are so significant in the small stocks that if it go up, it goes up very high. But if it go down, it goes down by like 63%, by 34%, by 26%, by 67% in 2008, right? 2007 to 9. So the downfall is also significant and upside is also significant. But in also similar way, the S&P 500 is down, but not that significantly compared to the small stocks. So that's the background of risk and return. So where you have the highest returns or you have the highest risk, you have higher returns as well. If you don't have risk, the returns are also very minimal. It's the individual investor's choice where they want to invest their money in. Whether they want to have a safest investment, they can invest in the treasury bills, no risk at all, but your investment will also not grow super fast. If you can take a risk, of losing your investment by 67% or 70% at one point of time in 1 year or 2 years, then you should invest in the small stocks. So they are traditionally growing in a higher speed. The only thing is you have to keep them up for a very long period of time, right? If you see, there are downsides like 1968 to 74 for 6 years, for 1 year, for 2 years, for 2 years, there are certain downs. But in a overall, let's say over a period of 5 years or over a period of 10 years, they're always growing. One thing that we learned here is the longer the investment, lesser is the risk, higher is the return. The background of risk. Now there are historical risk and returns of the stock. So this is the way of calculating the historical returns, or you can say like annualized returns, right? So if you are getting a return in 1 quarter, 2 quarter, 3 quarter, 4 quarter, if you want to calculate the annualized return or annualized return over a period of time, let's say you have growth rates in 1 year, 2 year, 3 year, 4 year, then you can use the formula of R annual by combining all the returns in together, this formula. In your real life, you have like 5-year growth period, right? Every year you are growing by 5% or 6% or 8% or 10%. So how you calculate the annualized growth rate? On an average, how much is per year growth? You take all the growth and then add and take an average, simple average, or how do you do it? If let's say I give you 4 years financial statements, 4 year sales, right? 1 year sales is increasing by 5%. Another year sales is increasing by 10%. The third year sales is increasing again by 2%. And in the fourth year it increased by 3%. So what is the average growth? I mean, there's a formula works, all the averages, you multiply them plus the 1, like make it decimal and then multiply all them together, and that will become your CAGR, annual returns, annual rates. Then you have the variance. The measurement of volatility in returns is called variance. This is just a theoretical concept. Don't have to worry about it. Let's say in 1 year sales is growing by 5%, another year is grow by 7%, another year grow by 1%, another year grow by 10%. What is the variance? Means what is the volatility? How volatile it is? You don't have a fixed rate of interest like an average, right? Is growing up and down, up and down, up and down. We normally measure the volatility of the growth. So the volatility we measure by this formula. So let's say year 1, year 2, year 3, year 4. And let's say we have an average of the percentage growth, right? In 1 year we get 5%, then 1%, and 8%, and then maybe let's say 4%, right? So this is the total growth in every year. So one way that we were calculating was the CAGR. So how we calculate the CAGR is, the formula was 1 plus, right, this 100 because it's a full into 1 plus this divided by 100. It should be plus. Between the bracket should be multiply. This should be multiply. All of this within the bracket should be plus. 1 plus R. So that was the formula. But it seems like maybe it's a compounded annual growth. Total is 18. I don't know. Maybe there's something wrong with the formula. But anyway, let me calculate the average, the variance formula I wanted to show you. The formula for calculating the variance or calculating the standard deviation is this. So this is the formula for calculating standard variance. Okay, so the way we calculate this is, first we need to take the total average. These are the number of units. The first point was to take an average, right? So the average is 18 divided by 4. So that is the average. Now this next step in calculating the variance is to calculate the variance, and that becomes this minus average. And the second step is to take a square of it, because you see in the formula you have R1. R1 is 5, minus sign is an average. So you take an average and then you are just calculating the the R minus R, R minus average, R minus average, R minus average, R minus average, and then you are calculating the square of it. So variance, so square, right? So basically what you need to do is you just need to multiply this by 2 times, and then what you will do is you will take a sum of it, divide by t minus 1. T minus 1 is the number of entries. So here number of entries are 4, so we need to divide by 3. So your variance is 8.33. This still does not give you how volatile is the stock. For getting the volatility of the stock is we need to take a square root of this. So this is called variance, and then there is another formula called standard variance. I don't know if you have heard of standard variation or not, SD, right? So that the formula is square root of this amount. So it's 2.88. So whenever the square root, the standard deviation is more than 3, it's super volatile. The standard deviation of between 0 to 1 is the closest. So it's ideally the value should be between 0 to 1. If it's more than 1, it's volatile. If it's more than 2, closer to 3, it's more volatile. And you can feel the volatility here. Average is 4. In 1 month it go down to 1%, another month it goes down to 8%. Only 2 months are near the average, right? So this standard deviation tells us how volatile is the stock. The concept of standard deviation is clear. The thing is, we want to understand how volatile is the project, right? Or how volatile is the stock. How volatile is the probability that in the future we will be able to repeat the performance. So in order to understand that, we need to see volatility in the past records, right? So what we do is, here is a sample of one project, different returns in different years. So one month it gave a return of 5%, another way it give 1% return, 8% return, 4% return, right? So you can see now in 4 years it has a very wide range, 1% to 8% return, correct? So how do we measure the volatility? So we can see it's already volatile. In 1 year its performance can drop to 1%, another year it can be very high, 8%, and the rest of the 2 year is general. But when you have a larger data, you may not be able to gauge in this way. So the one way to gauge is to understand what is the volatility, right? The volatility is defined by standard deviation. And standard deviation is, if you have seen the normal distribution, let me search something on normal distribution, like bell curve. I don't know if you have seen bell curves. You can see a image on the screen. Okay, so this is the parameter of standard deviation in normal distribution. The one that you see is like a bell curve. And what we assume is that every distribution, all the data can be put into a bell curve depending on how frequent they are. And this sign, the one that you say, is called the standard deviation. Round and 1, this sign is called standard deviation. So the standard deviation is +1, 2, minus the 1 only. Then it normally represents 66% of the population. If it falls here, is very close to the mean, means the performance is not very volatile. There will be not much of exceptional performance. Like in our data, we have 1% and 8%, right? Compared to the 4. Now 4 is the mean here. This is the 4.5 is the mean. Now this 4.5, it will lie here, right? If it's 4, it will lie here. But ±1 standard deviation means that 68% of the data is going to be normal. If it's 2%, if it's the ±2 means 95%, means majority of the performance is going to be within ±2. Anything more than +2 or -2 will be lying into the outside of 95%, means it's very rare to happen. If something is falling here, a standard deviation falls here or here, it means is very volatile. There is no guarantee that in the future you will be able to get a normal return or an average return. So it can go very high or can go very low. So the standard deviation defines the risk, basically. How risky is the project? Higher standard deviation or lower standard deviation will define that is super risky. Anything more than 3 is again very risky. More than 2 is already above 95%, in the top and below 5%. So the if it's more than 2, in our case our standard deviation is 2.8, right? It's falling here 2.8, which means this is a very high standard deviation. So our results can be in any direction, can be very high or can be very low. That is the general meaning of standard deviation. So if you want to calculate standard deviation, just put the numbers. So the number is D3 to D8. Is it D3 to D8? No, D3 to D8 or D3 to D6, but the result is same. You can see now. So the formula is the same. STDEV D3 to D6, the standard deviation comes to 2886751, and the way we calculated manually is also 2886751. If let's say standard deviation falls in the green line, means is the safest. The performance will never go higher or lower. It will deliver consistent results. Basically, that's the meaning. If you can look at the stock performance of the last 5 years and calculate standard deviation, if it becomes like plus minus 1, it means that the stock is able to deliver a very consistent performance and is not much of risk. There is no surprises. But if the standard deviation falls like this, the 2.8, then it means it's full of surprises. So it's because it's beyond 95% of the population, right? They are quite risky in terms of performance. So that's the meaning of this standard deviation. Well, now I would like you to calculate the standard deviation. Please try and calculate. Now you know the formula. It's very simple, right? You can use the Excel. This is how you can use the standard deviation as well. Our best estimate to expect a 10-year return treasury bond is average is 4.3% with a standard deviation of 9.6%. These are the standard deviations of since 1926 to 2015 of different stocks. Treasury bills 3%, corporate bonds 6%, and S&P 20%, and small stocks of 38%. So that's the standard deviation. So lower the standard deviation, lesser it's riskier, and then higher will be the returns. Okay, it's called normal distribution. So as per the normal distribution theory, these 66% will be in a average plus standard deviation, one standard deviation, plus minus, right? If it's plus minus 2 standard deviation, then 95% of the population will be sitting in this zone. Mean plus minus 2 into standard deviation. And if it's plus minus 3, then it will be 99%. So if it's a standard deviation of 4 or more, it's super volatile. You cannot believe it. Distribution here is the normal distribution. So 22% is on the near, 1.5 SD, and to plus minus 1 to 1.5 SD will be minus 20% to 64%, and plus minus 2.5 is here 67%. The rest of it is out. So it means that what is a 95% confidence interval for 2016 return. So now in the past example, we calculate the average return of 2011 to 2015, right? So average was 4.39% and standard deviation is 9.6% that we have already calculated. Now if we want to know what is the 95% confidence interval that our return will be confident enough, we can say is 95% of with the 95% confidence. This is how we calculate the returns with a 95% confidence. 95% confidence is because we know that 95% confidence is mean plus minus 2 standard deviation. Our return will range between 4.39% minus 2 into 9.62% to 4.39% plus 2 into 9.62%. So means with a 95% confidence we can say that the returns will be falling between 14.85 to 23%. If you want to have a much lower, like 1 standard deviation, then we can say okay, the returns will be minus 5% to plus 14%. Our confidence level is only 60% because we want to estimate the future performance. So you cannot estimate the future performance by standard deviation, but what you can guess is a range. So let's say 4.39%, we can say if we add 1 standard deviation to it, the standard deviation is 9.6%, right? And normal distribution will say minus and plus both. So if we say that range is 4.39% plus minus 9 to 9.62% or to 4.39% plus 9.62%. So what will be the result? It will be minus 5% to plus 14% or 13% or 14%. Our confidence level is, we are adding only one standard deviation. Our confidence level will be only 66%. With the confidence, we can say the next year performance will be in a range of minus 5% to plus 14%. But if we want to be 95% confident, then we have to add and deduct 2 standard deviations from the mean. So minus 2 into standard deviation plus 2 into standard deviation. So our range of guess is minus 14% to plus 23%. Then we are 95% confident that anywhere. So basically you are taking a guess. So with a guess, you can say with 95% confidence, you can bet on it that the return will be minus 14 to plus 23%. Obviously it will fall anywhere in between, right? If you want to be 100% confident, then you add 3 standard deviations, 2 standard deviations, minus and plus. It's called normal distribution theory. Okay, so these are summary of the realized formula that we had. Realized return, we know already that this dividend plus the price divided by the price of purchase, right? Annual return rates is the average of realized return each year. So R1 plus R2 and then divide by the mean. Variance of returns we calculate by squaring it up, deducting from the mean and then square it up. And then the standard deviation or volatility of returns is we calculate the standard deviation formula. And we get 95% prediction interval. We have to plus minus 2 into the standard deviation. So that was the understanding of risks. Now, there is a historical trade-off between the risk and the returns. So we have already seen that different stocks gives you different returns based on the different standard deviation, right? Different hostility. When we put them on a plot chart, they come up with this, right? So lower standard deviation means lower returns. Higher standard deviation means higher returns. So you can see there is a trend that higher is the standard deviation, the higher will be the return. Or you can say is the other way around, that if you want a higher return, you should be ready to accept a very high risk. So if you seek one, the other will automatically come. If you want higher returns, the risk will be also higher, right? If you are ready to take higher risk, you can get higher returns also. But it's not 100% complete, it's not 100% sure. Because you can go minus as well. The standard deviation work in both ways, plus and minus. The larger stocks usually have the lower volatility, but even though they have it. So it's a common versus independent risk. So there are 2 types of risk. One is common risk for everybody and there is an independent risk for few people. So imagine theft and earthquake insurance. So if let's say you are taking a earthquake insurance, it's common, right? Common with you, common with anybody else. Because when earthquake comes, it's not only it's not a particular company who is going to be affected, right? It will be the entire region gonna be affected. But with the theft, it's only one company. So that's the concept between a common risk versus an independent risk. So common risk is always earthquake, flooding, these kind of risks are common earthquake. And like coronavirus is a common risk because it's applied to everybody, correct? But an independent risk means a theft by employee or a bad CEO or a bad manager or a fire risk in the building, independent risk. So you have to manage those risks by yourself. So that's the 2 types of risk, common risk and independent risk. So for diversification, normally you want to eliminate the independent risk. You can eliminate independent risk, you cannot eliminate common risk. So how you eliminate the independent risk? So there are 2 ways of avoiding independent risk, right? One is taking the insurance. Diversification means, let's say there are 2 cola drink companies, right? Pepsi and Coca-Cola. If let's say you buy only Coca-Cola, you have a independent risk because if Coca-Cola plant burn, you will be gone, right? Or if Coca-Cola has a better product than Pepsi, then it's okay. If the Pepsi becomes more successful than Coca-Cola, you lose. But if you buy both, then you have avoided the independent risk in the company, but you still cannot avoid the common risk to both of the companies. So that is called diversification. So you need to buy different industries or different companies, all the companies in that area, so that you can there are multiple levels of diversification within the industry means you buy all the companies within the industry, so you can avoid the independent risk of that company, but you cannot avoid industry risk. Now there's second level of diversification where you say, okay, I buy all the industries as well, one company in all the industries, pharma industry, IT industry, every kind of industry. So you will be able to avoid market risk, global market risk, but you still cannot avoid certain risks which are common to everybody, like natural disasters and all those kind of things, right? Or the general economy is going down because of coronavirus. So those are the risks you cannot avoid and you cannot diversify. In a short, these are called systematic risk and unsystematic risk, also another term which we'll also have a look in the future. So that is called the systematic risk and unsystematic risk. The systematic risk is because of the country specific, company specific, or industry specific news or a market wide news. So the unsystematic risk is called company specific, or you can say independent risk, which you can always avoid by doing a diversification and buying the other companies in the same industry, right? So you can avoid the company specific risk. But there are certain systematic risk, means they are common risk to everybody. So they are market wide risk, they apply to everybody. You cannot diversify this kind of risk.